I would like to welcome everybody. My name is Neil Strachan. I'm the director of the Bartlett School of Environment, Energy and Resources, which is the umbrella school for 4 institutes, of which the Institute for Sustainable Resources, where Professor Nadia Ameli is based. This is Nadia's inaugural lecture. It's a chance for her to look back a little bit about the research and impact that she's had, and to look forward a little bit with the work still to come. Nadia is going to talk about climate finance. It's a super hot topic. It's extremely important to mobilize, particularly for developing countries. The numbers are very large. The number of actors involved are very complicated. So hopefully you'll make some sense of it for us this evening. Nadia is going to talk for around 45 minutes, and then we'll have a Q&A, and there'll be a roving mic. Then there'll be drinks and refreshments outside. They're not there yet, but I'm assured that they will be arriving for us, so we'll have a chance to ask more questions of our speaker if you don't get a chance to ask. But with that, I will hand over to you, and I'm very much looking forward to your talk.
Okay, thanks Neil for the intro, and good evening everyone. It's actually very nice and lovely to see so many familiar faces from really former students, current students, colleagues, mentors, some friends actually, and also new faces. So I just want to thank everyone for making the time and being here tonight to spend literally the next, I would say, hour together. I guess for me it was kind of an unusual moment when I was thinking about Inaugural, because it's indeed, it's a moment of celebration, it's a moment of reflection, but also it's a statement of intent. Indeed, I was trying to look back and also to the future at the same time. So I will be covering indeed some of the questions that I've been exploring with the team in the last more or less decade that I spent at UCL. It's literally 10 years that I joined UCL. That's the other birthday that I'm celebrating today. And also looking to the future, to what comes next. As I said, the talk tonight is about finance, but I won't be talking about finance as a sector or a set of policies or instruments. I will be talking about finance more as a way societies decide what gets built, in the sense of how basically we shape the future we have. And the core really of the talk is really what is in the title, which is how finance defines what the world is able to build. More specifically, I will focus a little bit more on risk. I hope the talk is also about imagination a bit, and I will be talking about the boundaries of finance and actually how we can shift the current boundaries in terms of what finance recognizes investable nowadays and how we can really expand those frontiers. I won't start with any models or charts or numbers. I just really like this image because I feel it captures very well the academic journey, but also I think it applies to life more generally. And it's about really your 8-year-old self, which is your curiosity, your imagination. I guess really the feeling that big things can really happen if you dream about those. And also the other self, which is your 80-year-old self, which is more the judgment, the perspective. And I think even more important is the fact that if you look back at your path or the choices and the decisions you have made, actually they still make sense. You're still happy about those choices. So in some sense, I would say this lecture is about this journey between these two selves. And it's really about trying to hold on the openness at the beginning, while gradually really developing this more realistic understanding of the world and actually some of the dynamics that we're trying to study. Now, let's go back to 20 years ago, when I feel this journey really started. Don't do the math, it's more or less 20 years. I was very young, that's my graduation day. It's my master graduation day. I wasn't blonde at the time. And it was really, I guess, when I was writing my master dissertation, I think I got this very big question that I guess many students are asked during the stage. It's really about what would you like to do in your life? And I answer with great confidence, I'd like to change the world. What else? What a master student can do at this stage? I guess at this age, if I look back at this girl, I can see two important qualities. One was definitely enthusiasm and energy, but the second one was even more important. It was my very lack of understanding of actually the world works. But I guess, apart from the naive question, the naive answer, there was a big question to be asked. And it's really about how the world evolves and what are the systems behind the world that shapes the trajectory that we're seeing and we observe nowadays. For me, one of those systems is finance. And finance is often described as a sector of the economy, but the definition does seem to be a little bit too narrow. Finance is also one of the systems through which societies decide definitely what gets built, where development happens if we think at global level, and we see the inequalities we see at a global level, which technologies scale and at which pace, and which futures become possible. So really, in order to understand the low-carbon transition, we do need to understand really how finance defines possibility. Otherwise, as I say, I think today we do have everything in terms of technology, or at least the most advanced technology are commercially mature. We do have the right projections, we do have enough evidence, we have the policy setting in place. I guess capital is still quite a challenge because if it doesn't flow towards those projects, we're not really able to change the systems, the infrastructures, in the future we need to build. Now, I guess really I want to move now to one of the main concepts in finance, one of the core ideas in finance, and this idea of investment frontiers. So if we look back really at the basic of finance, what we can see in the textbook is actually investors, they do basically allocate capital under uncertainty to maximize their utility. The utility is given basically by two factors, which is one is the returns, on the other side we see the risks. So investment decisions really depend on how investors they do interpret those investment conditions in order to estimate the risk, and whether those risks really are judged kind of acceptable given the return that we do expect. So if we want to draw a simple line, so this is a very simplified version, but basically this is what is defined in terms of investment frontiers. It's about what the financial systems or investors they do recognize as investable, or compared to what is outside this financial, basically, recognition. What is important to say is actually that this frontier is not natural. This frontier is actually produced by the model, the metrics, the risk that we consider, our market experience, the risk perception, through which, in general, risk is measured, but also is priced. So that means the return that we attach to the risk or the cost of capital. So in this sense, investibility is not simply discovered, but it is produced. It is produced by all those assumptions that we made. So when we think about finance, climate finance, actually, it's quite important to say that we don't really have a problem of capital scarcity. We don't just need more money. Global capital is not scarce in absolute sense. Really, usually in the first lecture to my master students, I usually say, what's the size of the financial system? If we look at the equity and the debt market, they are quite big. We have trillions in terms of available liquidity on the market. So definitely there are large pools of capital that actually are looking for investment opportunities. So the question is really not where we find more money, but it's more why does capital fail to recognize basically some places, some projects, and some futures as investable ones. So in this sense, I would say that one of the key messages that I hope to communicate tonight is actually we don't really have, or not only, an investment challenge in terms of funding challenge, so how we provide the capital that is needed, but it's more an investibility challenge, the one that we're facing. And when you try to make this switch, actually, it becomes a little bit more nuanced, the pictures, it becomes more nuanced, the set of instruments you need to deploy, and potential action in order to really change investibility as a concept. Now, just to look very quickly to some of the numbers we're talking about, those are basically the numbers when it comes to climate finance. We have seen a positive trend over time in the last decades. Actually, investments to low carbon assets and adaptation have been growing over time. There is this positive trend. But actually, when we compare those trends compared to what is needed, we can see that we need to almost to double basically the current levels. If we then take even a more nuanced look at where this capital needs to be mobilized, we can see that actually the investment challenge is in the developing world, where the scale of capital needs to increase by factor to 4 up to 7. And if we look even about the areas of the world, there are areas in the emerging economies where the capital needed is even higher. Again, if we look again at the numbers, what we see is actually that 80% of the total flows when it comes to climate are now in the concentrated economies. You can see Europe, North America, of course China. China is the leading country when it comes to low carbon assets investments. The rest, it goes to the emerging economies, but only 3% of these flows are basically reach the least developed countries. So we have really this challenge of we need to mobilize capital. It's not going where it's most needed. And also, if we think about available resources in the emerging economies, we can see that around 10% of the global financial assets are available in the emerging economies. So the transition is indeed constrained by where finance recognizes opportunities. Of course, there is a reason why finance and the capital is not flowing towards those areas and those regions. And this is basically a concept that we introduced with a set of colleagues that are even here in the room, where we talk about this climate investment trap, which is the situation that is a parallel with the poverty trap, where many emerging economies really are facing, which is the fact that climate investments, they remain chronically low due to a set of self-reinforcing mechanisms, like the fact that there is a high cost of capital, there are less investments, emerging economies are more exposed to climate impacts, that again, there are adverse effects to the economy, that further increase the risk premium, and again, everything feeds back to the cost of capital. So it's very hard to break this cycle, and I would say really that the climate investment trap are often produced by how investors perceive a price risks. When we look really this climate investment trap, a core metric behind is the cost of capital. The cost of capital gives us an idea very quite precise on how basically different economies and different countries they do have access to finance. And there is now very strong evidence showing that the cost of capital basically varies dramatically across countries. This is just a representation of one study that ran at UCL, but those are also macro regions that were fitting our energy basically models here. But actually we can see that there are countries where the cost of capital is very low, like Germany, 3-4%, to countries where it's very high. And in Africa, that's just an average, but we have nations like Congo, where the cost of capital reaches almost 30%. So again, what really seems like a risk is often a reflection of everything that is around those metrics and the risk estimates. Of course, there are macroeconomic conditions explain this, some of the vulnerabilities, there is more politically regulatory environment, institutional credibility, but there are also some more, I would say, soft metrics, like the fact that we don't really have many data when it comes to emerging economies. Investors are less familiar. We have, for instance, rating agencies that do have less offices and usually are not monitoring emerging economies. And there is also a bit of historical path dependencies that we've been studying and observe in actually reality. So very quickly, some of those dynamics and factors we have the chance to study here at UCL. We've seen that actually macroeconomic conditions that do shape quite strongly capital allocation. This is just a chart looking at international climate finance in emerging economies. And you can see that actually most in the last decades, 40% of the capacity additions in renewables, they only went to a few countries, only went to Mexico, South Africa, Brazil, Egypt. And this is really, there is a massive difference if you are in Mexico or if you are in one of the most vulnerable economies. And this is really, as I said, the results of several macroeconomic vulnerabilities, but also other factors. Another one which was quite important in shaping and determining those flows is actually path dependency. So the history that you have around renewables, the fact that countries with very early renewable deployment, they do accumulate strong advantages. There is really technological financial learning. Investors tend to be more familiar with those contexts. There are network effects and locks-in dynamics. So the investment frontier sometimes is also shaped or enforced by history. Then given this context, how the world has been responding. If we look really at the major international initiatives in the policy side, the main policy side was really de-risking, because we know that macroeconomic factors have been really shaping capital allocation, cost of capital. Basically, there are some, I just basically mentioned you some of the initiatives at the international level that have been deployed in order to hedge, to mitigate those risks. One of the most famous and the most recent one was the one, the EcoInvest program deployed in Brazil by the IDBS. That's, I guess, when also I just started to show a little bit the work we're doing now and the future. So one, I feel the way usually finance has been thinking about mitigation of those risks is through this really, I would say, called linear understanding of risk. We have, let's say, best in class, and then if you want to estimate, for instance, the risk in Congo, you try to have, okay, in Congo there is also this specific risk, which can be about currency, another risk which is political stability, and then you try to sum up all the risk, you attach a premium, and that's the way a risk premium or the cost of capital will be computed. If the logic goes in this way, the way to mobilize capital, it would be to design specific instruments or hedging instruments that can target specific risk. So we will deploy the risk instrument for risk number 1, a deploy risk instrument for risk number 2, and so on. And the idea is then that you break down those risks to the target level. So it does seem quite, I would say, straightforward, because we do have all the tools nowadays in terms of hedging instruments, in terms of guarantees, in terms of, as I say, hedging instruments that we can address those risks. But the question is still there, why we haven't seen this massive relocation capital towards emerging economy, or what is most needed. So that's, I guess, the intuition where we start our work, in sense, okay, maybe we're kind of missing something in those dynamics. This also I just want to show very quickly an example of how this linear understanding actually translates in current approaches. This is basically a snapshot taken by the website of the International Energy Agency, and it shows exactly the implementation of this approach. It shows this is the case for India. It's actually not the cost of capital, it's the levelized cost of electricity, but it doesn't really matter. I think the logic behind is the same. You have all the risk in India, and on the other side, a potential instruments that can target those risks. But as I was saying, even if we do have all those instruments, why capital is not flowing towards the country where capital is most needed? So one of our intuitions is actually that risk is not linear. Risk does compound, and you can see really in the real world setting, investment environments are quite complex, are characterized by a spectrum of risk. They do amplify each other, they offset each other in some applications, they do trigger some thresholds, and they can change the investor confidence in a non-linear way. Very quickly, I just want to show here the case of two countries in South America. One is Brazil, the other one is Argentina. Same region, same macroeconomic condition broadly. But in Brazil, investment are still flowing, while in Argentina, not that much. And one of the reasons, because despite both countries, they have high currency volatility. So if you think about, okay, what's the major risk in this country, they do show exactly the same currency volatility. Actually, other risks are quite different. And in Brazil, the reason why capital is flowing is because there is a strong policy, renewable policy basically in place. The role of the national banks, development banks are quite strong, and that does make basically difference in capital allocation. We don't have the same in Argentina, and that's why we don't see the same effect. So investibility, it does depend on configuration of risk, or the set of environment that you see, rather than isolated risk factors. What we did was really when we tried to think along those lines, actually, one of the aspects that we try to do is actually we're borrowing from ecology. We're basically learning from ecology as a way of modeling climate finance in a different way, just because we thought, okay, maybe the models that we see now in finance economics do not really fit, partially not reflect the complexity within the environment. So if you will ask an ecologist how they will model, for instance, species survivals, they will look at the environment. They will look really at the condition that must predict or can predict why basically, or the likelihood that a specific species will survive in one environment. They will look at how vegetation, soil type, water availability, climate, they would interact. They will try to model all conditions together to see possible evolutions. So what we did was to think along those lines and think about investments on a very similar way. So maybe investments are really shaped by the set of risks that are happening at the same time in a given, basically, space. So what we're trying to model is really this idea of investment spaces to show really where and under what conditions investment is most valuable. And that's, I guess, one of the key concepts we're working now in our team, which is really this idea of a new framework of the investment space, which is offer really a multidimensional lens for assessing all the risks together, taking into account those interactions, those compounding effects, in order really to better understand the condition behind investments. And really, and the one way is really to exactly capture those interactions, either there is no linearity, and also to see whether there are some threshold effects or literally some even tipping point, I would say, in terms of no linearities in risk dynamics. Very quickly, that's the most technical slides I have, so very quickly, just want to give a flavor on how we do this. We tried really to map basically investment spaces, and the idea is we start from observed investments, so where finance somehow went and flown, so somehow where finance said yes. We then define risk profile for each project, so what kind of condition made those investments possible, because we, as I say, we see a set of risk behind. We then draw in the investment boundaries. So we're trying to find this space that investors they found basically acceptable in terms of risk return provide. And then we're then using another algorithm, which is more about estimating the likelihood on the distribution of the data. As you can see, those data, there are some parts where are darker, so that's where the data are concentrated, compared to other parts where are more sparse. When you overlap these two images is when you finally can get this map. And we can finally basically map the investment space, a map where capital can flow. Why this matter really in practice? I mean, we do this, of course, because we're quite excited about this new modeling technique, but it does matter in reality, and those are just some examples of the application of this approach. Here you can see the first chart, basically a set of countries in the emerging world who are all very similar in terms of investment suitability. So they're quite suitable, in capital is really flowing, but when you analyze the level of risk behind those countries, it's quite different. Again, if you take Brazil, high currency volatility, which is the FX, but then the currency volatility is compensated by other variables that are quite strong. If you take the case of India, again, very similar suitability in terms of investment, completely different set of risks. It's way more risky from a sovereign perspective. There is no currency risk at all, and very stable on other dimensions as well. On this other set of countries, we find instead countries with a very low suitability rate. That means they're not really suitable in terms of investments. And you can see here all the set of risks that are basically compounding and creating larger effects when it comes to risk. So one of the key points is actually that investment decisions are really shaped by those risk configuration. Risk influence basically each other in complex way. There are no linearities that actually we can leverage and we can study in more details. And risk can really balance, amplify, or accumulate depending on the environment that we're studying. That's more a presentation on when we try to measure basically those risks in practice. As I said, investors that do respond to risks, so if there is actually a strong risk in a country, this importance and significance is indeed perceived, but also responds to risk collectively. So in this chart, basically, we study a set of risks. The darker area represents where the risk is most commonly basically concentrated for the solar project that we studied. And basically, the way to read this chart is actually one important finding is the spread. A narrow spread means that investors require the risk to stay close to this specific level. A wider spread means investors can tolerate more variation. Sovereign credit risk is quite wide. So that means investors can handle different level of sovereign risk. Risk tolerance is uneven. As I say, you can see changes quite significant depending on the risk you are targeting. And the implications of actually risk are really contextual. So some risk must remain low for investment to occur, while others can be absorbed if the wider investment environment is supportive. So with this initial empirical finding, we start to see that actually the investment frontiers as a shape is not that linear and is not really a simple line. It does changing depending on the risk we are looking at. Just again, some example very quickly. As I say, this set of risks, the currency, the interest rate, the growth, they are tolerated at moderate levels, so they need to be in this narrow distribution in order to capital to flow. Others, as I say, they need to be quite low. On the negative side, that means that they need to be quite low, not that high. So governance-related risks are poorly tolerated by investors. That means really investment environments are considered attractive or when really political instability, weak institutions, and sovereign risks remain relatively low. But there are also some sovereign political risks can be tolerated when offset by other risks. So the distribution is quite wide. Just to say, they need to be low in general, but investors we've seen basically investing in some, as I say, middle-income, low-income country, even if there was high, basically political uncertainty, a high sovereign risk. The other finding that we collect some evidence is actually that investors that do respond actually collectively to risk. So the way to read this chart is actually to follow the line. Every color line represents a combination of risks. So you can follow the pink line, the green, or the blue. Those are basically an extraction of the data where those projects have basically the highest currency volatility in our data set. And this chart shows you, if you have high volatility in the currency, how the other risk might have to look like. And you can have very different set of combination. Here I just extrapolate 4 of those to show you different cases of where you have high currency volatility, but still investment are flowing. The case of Brazil, for instance, is the red one, where you have a high currency volatility, but you have a low risk in terms of policy, renewable policy. That means you have a strong renewable policy context. But you have, as I say, other combination where you can see that actually investments are still happening. So this comes really, I guess, to more the latest results or the latest, I would say, directions that the work I do with the team is now focusing on. As I say, we start with this idea of the investment frontier that really defines what the financial system recognizes as acceptable, as recognizable, compared to the opportunities that are outside the financial visibility. So when now we're able to understand a little bit better these investment frontiers, a project can be outside because, as I say, the characteristic of the project doesn't match those that are thought to be suitable for investment to occur. So in this case, we need to deploy instruments that are frontier crossing. So that means we need to improve the project characteristics so they fit the existing recognized investment profiles. And that's really the simple case when you have really a project where you have, let's say, a solar project where it could be bankable, but you have this specific risk which is quite high, doesn't fit what usually investors would recognize. And then you need to deploy instruments that can hedge against this risk. The most advanced version is more if we're able to move the frontiers. If you're able to enlarge and expand these frontiers in a way that more projects will fit and will be recognized by the investors. In this way, we need to deploy actions that are able to shape the frontier. And this case is really where I guess this new way of modeling that we're kind of testing is basically try to shape a little bit the analysis. We change basically how finance recognizes, combines price and manage risk. We recognize whether there is a missed opportunity because the risk was overestimated. The pricing wasn't right because, as I say, we can capture those non-linearity in a better way. The distinction matters because, as I say, frontier crossing mechanisms would ask, how do we make this project acceptable to finance? Frontier shaping mechanisms will ask, how do we change what finance is able to recognize as acceptable? And I guess we definitely need both. But the second one, yeah, it holds, I feel, more potential. Just to make this a little bit more visual, because I feel otherwise it's too abstract, this is really how we try to visualize this idea of the frontiers, crossing and frontier shaping. As I say, this is basically the upper volume that we try to design in our group. Actually, here we have only 3 conditions just to make it a little bit simple and nicer. But of course, we model, as I say, in the follow study, we model 8 variables. We are planning to expand more variables. But basically, if you see the orange peaks, they do represent where the suitability of investment is high. So basically, this is where the projects that basically got funded are sitting. And you can see the level of risk that those 3 variables will need to have in order to be there. So, but there are quite a few projects that are outside these orange basically peaks, which are the blue areas. Those are basically projects that are outside basically the investment frontier. So we need to bring back those projects into the orange areas. And we do this through, as I say, guarantees, blended finance, risk hedging. The other one is what I was talking before about in terms of frontier shaping. We need to change really how finance assess risks, new risk assessment and pricing in order to expand those orange peaks. So the investment space becomes much bigger and much larger. We can absorb more projects in this area. When you think about those mechanisms at the country level, you can see that actually we can shape it, we can be a little bit more precise in terms of country pathways. Because different countries, they need different pathways. Each country, it does occupy a different position in this investment space, and also, I would say, different position across time. Because if you look at the history of countries, they're of course exposed to different extent of risk if you look at, for instance, 2000, 2010, 2020. And here later, just a very quick example to give us a flavor again of where some countries are sitting nowadays and what kind of combination we can identify. For instance, again, Nigeria is definitely a country with very high sovereign risk, but there is a strong renewable policy in place. Then again, strong utilities that can basically offtake the electricity, and that really helps to build the confidence in the market despite the sovereign weakness. And we have, let's say, other several cases that we can identify. I guess what we've done in the last, it took a while for us to do those few things. It took at least 1 year and a half. What we did in the last, let's say, 1 year and a half was to apply this new thinking mainly to mitigation assets. And we took solar as the first case study where we test those initial ideas. We now have some empirical funding, proving eventually that this approach can work. But actually the same question can be more broadly applied. And the question then becomes, when does finance really recognize planetary value as investable? And here, as I say, if I can think about planetary investibility, this can be understood as the condition really under which investors that do recognize value and allocate capital towards asset project geography that are essential to sustain basically planetary stability, which means not only mitigation but also adaptation and biodiversity protection. And this is really the new frameworks towards which we are working as a group. So if we think about those 3 different, I would say, asset classes or type of intervention, we define biodiversity as an asset class. But basically we have those different frontiers and different planetary assets that do face those different frontiers. Mitigation is the easiest one. This is one to model, this is one to see. It's very financial eligible to the markets, there are clear cash flows, there are established technologies, and project finance models are available, have been deploying really for the last 20 years very strongly. Adaptation, that's harder to monetize. The value often lies in avoided losses. Benefits are shared long term, and revenue models are way less direct. But the real challenge is biodiversity. This is the least financiable legible opportunity. And that's because ecological value is so hard really to, I would say, measure, verify, and price. I don't even know if we can give a really price to some biodiversity loss. And cash flows are often uncertainty and indirect, and there are also other variables that do matter a lot, like governance, lender tenure. So the harder it is to recognize the monetized value, the narrower the investment frontier becomes. And that's particularly true, I guess, for biodiversity. We are kind of close towards the end. Actually, I took less time than expected. I was worried I was speaking too fast. But basically, those are really the research agenda for expanding the investment frontiers. I've been thinking quite a lot about, okay, what we're going to do next as a group, as a team. This is kind of the future works, and I hope that our future work asks those 5 questions, which is really how are investment frontiers formed, by which models, institutions, and histories does finance decide what is investable, and you're already somehow seen that there's some path dependencies, some opportunities are recognized more compared to others. How do risks really combine to shape investability? And really, what kind of risk configuration make investment possible, marginal, or unlikely? And that's where our initial evidence have been now informing this question. Where do nonlinear thresholds occur? There are really those nonlinearity that we can better leverage, where we can see really a small change that can trigger to a larger change in investor confidence. And we've been starting to testing this hypothesis where you can reduce some of the risk at the moderate level. So we're not really taking completely away some of the risk, but you reduce to moderate levels. And it does change dramatically the probability to invest. And when exclusion is real or when it is a misrecognition, so also what we want to understand is if capital doesn't flow to some regions or to some projects, it's because really we have too many risks that we cannot handle, or there is, again, some missed opportunities that we are not able to recognize, and actually we can leverage those conditions. And the final one, which is the most important one, I think, in terms of impact, is about how can frontiers be crossed, shift, and reshaped. And again, how we can make sure we have enough evidence to prove, to move basically the projects into the frontiers and to change the frontiers itself in order to be expanded. So I would say that really the future of climate finance is really not just about moving money or capital. It's really about expanding the space of what finance can make possible. That's, I guess, it's where the importance is. So back to the original question. I think, as I said, I once thought that changing the world means find the right solutions. I guess we are a little bit obsessed about this idea, okay, there are a solution that we need to find and we're going to deploy. And I think it also means understanding why some solutions are recognized, founded, that they work and built in the first place, while others that do remain outside the frontier possibility. So I think to change the world, we might also change what the world's financial system are able to see to support the build. So if part of this work done through the team does contribute to a small part of this, I do hope that still my 8 years old self and my 8-year-old self will be quite happy in the future. And that's the final slide. There is still a final slide. It's a thank you. I guess I just want to thank you first, all the people who made this journey possible. And I mean, it's especially if in an occasion like this one, an inaugural lecture, we tend to believe or think about the research is quite an individual effort. But I guess there is nothing more collectively than a research journey. And I guess this one couldn't be possible without definitely the team. Those are the real, I would say, superstars, because they're really running the models. And then sometimes we do have dark hours. I've been there, but now I observe those dark hours more from, let's say, by supervising the team. And Michael, I was struggling to put you in the team or the mentors by the side of the team. Then, of course, I had mentors and close colleagues who have been really supportive in any way possible, with the chats, with the lunch, with the advices. I have my partner here, who definitely does a big job at home in supporting me when, I'm kind of panicking, I'm stressed, so I need a little bit more space. So definitely big thanks to you, Michele. And I guess a big thanks goes in general to also everyone in the room who somehow had the pleasure to work with and to learn from you. So thanks a lot for coming, and thanks a lot for helping me in this journey.
Thank you, Nadia. We're now going to move to Q&A, and Velvet, you're going to be roving mic person. So we're not looking for lengthy observations. We are looking for short questions. Could someone start us off? I'm going to give them both.
Oh, sure. Thank you. Thank you so much, Nadia. Such a great presentation. I think I learned a lot and it inspired me a lot as well. I have a particular question. In one of your slides, you talk about 3 frontiers: mitigation, adaptation. Sorry, I'm looking at my phone because I took a picture. And biodiversity. I'm particularly interested on biodiversity, where you say the ecological value is very difficult to measure, and also cash flow is not certain. So I think because I have been looking at the biodiversity offsetting policy in the UK, I think biodiversity finance is moving towards the direction of carbon finance to become more standardized and more, even in the voluntary market, there are more private actors is involving credit rating agency, and all these kind of people are involving from the institutional level. And how do you think it will be different from carbon market, considering like social kind of environmental justice issues, and how do you think the biodiversity finance will be moving towards in the future? Thank you so much.
Should I respond? Okay. Now, thanks for the question. I guess really for me, biodiversity finance is really the frontier, and really it's where now finance is emerging, but where we know very little. And it's really hard, I guess, to attach this economic value to biodiversity finance and investments. Some of the projects can see a little bit more kind of where finance went, where there was, of course, a market, or there were credit markets. I'm learning actually from you, Diego, on this, on the thesis, on the dissertation. One of my students work in this area. But yeah, I guess it's very much one of those areas where we don't have many tools, so we're not really able to quantify those aspects. It's much easier with mitigation with carbon. It's just, I feel, very easy because you can see very easy the cash flow. You can see, I mean, we have also all the, I would say, financing models, the financing structure, while for biodiversity, I guess we are not there yet. We have way less data. As I say, more data are available for the nature-based solutions, but it's very hard, as I say, to attach these economic values. I guess there is now quite some interest in the market, and I'm trying really to partner with financial institutions to better understand what are, again, the key variables behind those, basically, biodiversity finance projects in terms of what are the key risks and what are the key values, and what are the kind of characteristics that eventually we can try to model, or at least to have some direction in order really to improve the financial products behind. But I guess it's very much the frontier now. I don't think we have enough evidence at the moment.
More hands. This is an odd room because everyone's so far apart, but there's anyone here, and if anyone puts their hand up, I'll try and do next. We've got 2 weeks. Please.
Thank you. So I have a very, well, maybe a series of short questions, but related to a specific slide. So I don't know if you're willing to go back and kind of unpack. So it's, you kind of flagged it as being the most complicated or detailed. It showed the reshaping of the frontier. So further back.
One. This one?
No, further back.
Back?
It had sort of.
So you tell me when I have to stop.
Yeah, that,
okay,
that,
sure.
Okay, so is this, so first of all, is this a stylized or an actual sort of modeling run or presentation?
No, those are real data. Actually, Sumit is our researcher who was running the data and generated those charts. Those are real data. Basically, we took Bloomberg New Energy Finance data, project level data. Those are solar projects that have been happening in the last 20 years. That's basically the timeline the time frame that we target. Each dot represents basically a real solar project. Here as I say, it's a little bit hard to imagine everything, but basically behind each dot, which is, as I say, one specific project, think about 1 megawatt solar project in Tunisia rather than Germany or another project. We then reconstruct the variables behind. So for all those variables that we've seen, we quantify those variables, we quantify the interest rates, we quantify the currency. We then reconstruct the risk profiles. So basically, we try to define the risk profiles which were common, try to see a path. We then use machine learning to draw the boundaries. It's really there are basic technique for basically path detection, where you can define, as I say, a line, it's this boundary, if we call, where most of the data will concentrate, and then we attach basically a probability function more in this area, where we can use another machine learning algorithm, which is the net density function, and basically in order to help us to see how concentrated or sparse the data are. So those are real investment data, and then we apply some machine learning to get a little bit more an understanding of the path, the conditions.
So, and this is probably the second one down. When you create that risk profile, is that based on purely on empirics, or is there some kind of qualitative assessment that happens to plot those?
Yeah, unfortunately for the moment it's everything quantitative. So for the variables, this one, what we did was to try to track those 8 variables in that project. In each project, we had basically 30,000 transactions, was a massive data analysis. We tried to measure the currency, the interest rates, the growth risk that we used when basically specific variables were available. We used the variables. In other cases, we use proxies. So everything is done quantitatively. Something that I'm hoping to do, for which I'm actually now fundraising, is actually to validate this through case studies, to have a little bit more these qualitative nuances, and to see how investments are really happening in real setting conditions, really through the case studies where also the most vulnerable areas are, and we can validate better the data. For the moment, it's mainly quantitative, the effort that we've done.
Okay. So maybe just 2 quick questions that you can contextualize. Thank you. So one is, I mean, you mentioned the time series and that you extended, I think, back 20 years to get this kind of data capture. And so one is changing conditions over that time frame and what that does to the shape of the boundary. And then to the extent that you can do something about that. The other is about data quality and data completeness. So maybe it's 3 small things. And then when you think about the redrawing that boundary or how to reshape it, I guess how transferable is, do you do this as a one-off per country and per sector, or is there, I don't know if that makes sense.
Sorry for the lack of clarity. It was much bigger than I said. It was 30,000 transactions just on solar. Yeah. So all the projects we analyzed here, this is a kind of our initial pilot study, is done on solar projects. So there are no other sectors. And it's a global data set, so we test those data at the global level. Of course, we have countries where the representativeness is much higher. In the emerging world, we have, of course, less projects. And this starts actually from 2005 until 2018, and now we are in the process of extending the data set until now, and to basically include wind. So again, to validate another very, I would say, commercially viable technology where at least you can take off the technology risk. One of the reasons why we choose solar and we are going to add wind is because this way the technology risk cannot be considered, because those are kind of commercially technology variables. It's important to say that we collect those variables for each project in each country for each year. So that means currency. If we look at currency in Brazil, we look at currency 25, 26, 27. So I think we tried to, as I said, there was quite a massive data exercise in order to reconstruct these risk profiles. And then we tried really to identify common risk profiles in trend across the data set. But I'm sure, we can improve it.
Thank you. There are lots of other questions now.
Oh, sorry.
For those. We're going to move to Tristan and then the gentleman in front of us, please.
It was on one of your conclusions, Nadia, and congratulations for this, and thank you for inviting us to this opportunity to share. It was on your conclusion, which was like we need to change the way that we work as financial decisions. Sorry, it was a bit later than that. It's your penultimate slide. Yeah, this one. To change the world, we must also change the world's financial systems. I was wondering if you could give us a few thoughts on which part of the financial system are you most optimistic or excited to being able to change? Is it the governance institutions, the private sector, the development banks, the credit ratings agencies? Where do you see the greatest opportunity?
Yeah. No, thanks a lot, Lisa, for the question. I guess when I was thinking about this framework, that's really what we're doing. It's mainly to validate with investors, so with the people or the participants who are making basically real investment decisions. It can be used also by the rating agency because, of course, we know quite well, and there is some literature in terms of the bias that the rating agency usually have in terms of assessing market fundamentals against other variables. For market fundamentals, I mean the typical macroeconomic variables like GDP, inflation. Those are basically the variables that the rating agency will rank emerging economies, and we know they won't score very well. But it's mainly the framework, I guess, where we hope to make a little bit a higher contribution is with basically investors, really the kind of the participants that will need to allocate the capital, and I'm really thinking about more the public institutions and the private ones in terms of those assets. This project also where we hope is going to speak with to international organizations, because those are basically the organizations that are shaping those instruments, and also other organizations best placed in order to deploy, let's say, some global mechanisms that can be applied to several countries. There was basically some discussion, for instance, of whether we should establish a global facility targeting currency risk. That was one of the proposals of Avinash Prasad a few years ago, still fighting for this. And this is some of our analysis we hope can speak to some of those initiatives, because we can quantify those effects. We now can quantify the effects, we quantify the costs. Hopefully we can try to project the efforts and what are the gains. So, as I say, it speaks to some of the policymakers, but mainly to investors. I don't think I aim to change the credit agency. I would love to, but I think this is really doable at the moment.
Thanks, Nadia. Thanks so much for this presentation, and also for all your work in this space. I think I have a clarificatory question on kind of the waterfall chart versus the frontier piece, and it's the way you kind of set it up. There's many kind of risks in the waterfall chart that you address, and then you come down to kind of an investable project. Given that in your data set all the projects are real projects, and somebody made an FID decision on it, essentially they thought about one or two of those factors in that waterfall, thought it was addressed, and reached a return expectation that they thought was enough to kind of go. So I'm wondering how, and maybe there were linkages from your work that had even lower kind of risk, so they made higher margins. So I'm just trying to understand why is this different from just saying, well, you addressed two of these risks, this project became investable, versus this linked approach, because all these projects are kind of by definition, because they happened in the data set, kind of somewhere in that waterfall chart, something was addressed, otherwise it wouldn't happen.
Yeah, no, thanks a lot for the question. I guess there is one fundamental question we start to say, okay, we want to start from the empirics and to look what empirical evidence is telling us in terms of finance has been able to finance and recognize as valuable assets. But I guess there is an important part of the work that I haven't shown today, because we're still working on those results. It's basically the next step. When you get this understanding of the risk configuration and those nonlinearities, the next natural step is to basically address those nonlinearities. So basically, for instance, again, going back again to this economies program in Brazil, that was a massive program where IDB invested $5 billion to address currency. The question that still remains, was this the good choice? It was the best of use of public money that IDB did. We don't know, probably not. The reason is because basically you don't really need to take away entirely what risk. Of course, if you say, okay, I have currency, and I deploy this hedging mechanism where you can fix or set the exchange rate between two countries, then you take away the currency volatility. But you're taking entirely away what risk that probably was not needed. Probably you just need to address by 10% this risk. It would change strongly enough they basically probably to invest in that project, because also would have some other impacts on other set of risks. That's what we are trying to model. Actually, we do have some empirical results. As I say, I thought it would be too heavy tonight to present, but basically we can see that by reducing to model and label some risk, you can change dramatically basically the capital, according to our simulation, of course, the the probability to invest in some project. Usually you are not able to see basically those comparisons, those data when you address one specific risk in isolation. It's basically, I would say, for the same amount of money, if you have those 5 billion, what we can achieve. We can achieve 10, but if we can achieve 50, we should go for 50. That's a hope where this work will lead.
And what's most cost effective of which risk
Yeah.
from a fiscal point of view?
Yeah. Thank you.
Thanks, Nadia. I think you've done your 8 and 80-year-old self proud, so that was fantastic. Thank you. I wanted to build on Tristan's question and push you a little bit further. So imagine you had half an hour with the president of the World Bank, and you haven't yet done all this research that you want to do to get to the next steps. You know, what sort of things should they do differently? Because I think what you're saying is that these combinations of risks are very context-specific. They vary across countries, sectors, maybe technologies. And, you know, the World Bank, like all international organizations, although they always write reports saying one size doesn't fit all, they tend to see the world in that way. And yes, at the moment it's currency risk, and tomorrow will be something else. But can you see a way in which you could advise them to move to this more sophisticated way of looking at things, using these kinds of tools and data? It's quite a different way of operating. So, you know, what would you advise him to do if you had half an hour?
Yeah, no, thanks a lot. Actually, we are in conversation with the World Bank and IDB on this, hopefully. I'm not sure if they will implement everything we suggest, but there is a conversation, a channel open. There are 2 points. One is about those country pathways that we can help to design. Basically, we did run a case study on Brazil, so we track basically the different set of risk in Brazil, how they were changing. As I said, didn't show the chart today, but it's quite clear the combination of risk changed over time. Currency was always there, but there are other risks that were better mitigated and hedged over time. So one point is definitely having this analysis at the country level, so you can see the country pathways. The second one, which is what we're trying to push, especially with the World Bank, is the approach from micro to macro, so getting basically rooting or basing their macro models into this micro evidence. That's what they've been asking us to say. They quite like this idea of the investment space as a way of modeling conditions and building around this concept. And the linkage will be, the micro to macro in order to have more, I would say, macroeconomic consideration and to have those aspects englobed in their modeling. So on papers, we are great in terms of intention. I don't know if it's going to translate in real funding or real changes, but there is goodwill.
So I'm now looking for perhaps a last show of hands to see if we have 1, we have 2, we have 3. I'm just going to tell you that our refreshments are outside. So for that, these are the last 3 questions, short, punchy ones, but please.
Hi Nadia, thank you for the excellent presentation. And I have a very short question. My name is Francesco. I was quite interested to see that these are real data. And but also at the end you kind of split the type of investment into mitigation, adaptation and biodiversity. A bit kind of following up from the first question. Did you notice any difference in terms of what kind of frontier we need to move depending on the type of project? Because adaptation, the investor that goes into adaptation is very different from the one that goes to mitigation. I mean, much more long-term run. Thank you.
No, thanks, Francesco. And I would say that most of those questions are very much unanswered. I don't have the answer. I hope I will have at some point, but all the empirical evidence I present tonight, it was more about mitigation, it was about solar project. That's our first, I would say, again, pilot study to test the model. What we aim to do next is further reinforce the evidence around mitigation, then to expand to adaptation and biodiversity. As I say, unfortunately, I haven't done this work yet. I'm fundraising, in case anyone is interested in the work. But those are for us really much more the frontiers in terms of modeling. I think I'm pretty confident in adaptation. I need to be more concerned about biodiversity because it's quite challenging to model just those conditions. But thanks a lot, Francesco.
Great. Hi, Nadia. Thanks very much for the great presentation. I found the aspects on risk and the investment frontier certainly very fascinating. I guess my question is around the other side of the equation, which is on the return side. Do you see that forming a part of future work, or was that a part of the existing work that hasn't been discussed today? Thank you.
Thanks, Luke. And thanks also. I look a lot about your work and the cost of capital. As I say, I think in finance there are those two pillars, risk and return. I guess if we work on the risk, we have much more room to change the value proposition. Because, I mean, you have the set of risk that you can work on. On the return side, it's much, I would say, led by global trends, because you will be comparing investing in renewables against another assets that will give you similar returns. So the only way you will change returns eventually to subsidize the renewable projects or the adaptation, whatever is the asset we're looking. And in a phase of market expansion, perhaps, or even now, you want to invest in IT, or there are some of those big companies with very high returns. So I guess acting on the risk side, it can improve, as I said, the value proposition much more. There is also literature in finance suggesting that risk is the main driver behind investment decisions. We're much more worried about risk rather than returns, because we're much more worried about the money that we can lose, the risk we cannot handle, the uncertainties around those challenges.
No pressure. Hi, thank you again for all of the work and the presentation. I was going to ask about opportunity too, so I'm going to go to my second question, which is about whether finance is one thing or one actor. With these kinds of presentations, sometimes I think people talk about finance and capital as if they are like a Edwardian baddie who's twirling his mustache in a black and white film, like there's one thing. With the mechanics of how an investment frontier moves, is there something important about which actor moves first and how they move? Is there something about how that then creates a path for the next ones and has implications for the policies that are put in place? Like, do we need to segment into like first movers, second movers, and think about how the qualitative nature of why they're making different choices and how they're recognizing that the frontier is there in a different place to everyone else?
Thanks a lot. Well, we definitely know that there are different risk appetite depending on the actors we are targeting. If it's a venture capital, it's a public institution, it's a private investor. So different actors, they do have different risk appetites. They're looking for different risk opportunities, risk and return opportunities. I don't believe finance has a purpose. I guess it has to be quite clear. Finance is just a way money circulates from someone who has money and want to have a return on the money, someone who needs money. So I don't think sometimes we attach this negative or positive feeling about finance. I don't think it has any. It's about the framework, the regulations to set really the direction where capital eventually might go and to set the incentives to make this change. First mover or not, I definitely see that some actors, especially in the public space, if we look at the MDBs or any public actor, they do have something different in their mandates, and they can be the first movers in terms of creating the conditions where the conditions are not there. So definitely if I would express I want to be the first mover, it's definitely not the private investors, it's not an institutional investor, it's definitely the MDBs or in general public institutions, because first of all, they can handle better the risk and they can set the direction and the priorities. So to me, those are the actors that will need to create the playing field, if I may.
So, as your head of department, I hope you are a professor at UCL until you are 80 years old. But for now, please join us for refreshments to celebrate this milestone in your academic journey. And please join me in thanking Nadia one last time.
Thank you.